Hello, and welcome to the Portfolio Matters Week 25 weekly update. Keith is currently on a walking holiday, and so I'm presenting this on my own, so it'll be a rather truncated version, but hopefully you will find it useful. Before I go any further, I shall read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So, in the news this week, few items picked out. Biden has secured a $1 trillion infrastructure spending bill, and we know that this is going to have a significant effect on putting more money into the US economy and presumably on using more resources, natural resources, steel, copper, and so forth. Bank of England has left rates unchanged despite increases in CPI. Amazon has put a floor under, effectively a floor under the US hourly wage rate at around about $15 per hour by guaranteeing that all of their staff will earn a minimum $15 per hour. And one of the points that people use to suggest that inflation isn't going to persist is that you can't really get sustainable inflation without wage inflation. And this type of action, which is a response to the high levels of social security that people have been receiving during the pandemic and their unwillingness to go back to work for less than that rate. The problem with this is, of course, from an inflationary point of view, is that it's embedding both higher wages and higher wage expectations. And I think that is likely to make inflation more sticky. The US dollar index bounced to a 2-month high. And last year, in 2020, global household wealth rose by about 28 trillion, and an estimated 5 million new people became dollar millionaires for the first time in 2020. And that is a consequence of all of the financial easing by central banks. More money printing, more people with more money. So this is the US dollar index. Bounced to the 2-month high, subsequently fallen back a little bit. It's still in a sort of overall downtrend, but it hasn't moved anywhere since November. So for 6 months, it is back where it was 6 months ago. In fact, pretty much back where it was 9 months ago. Bit of an update on COVID-19. The number of cases in Africa is increasing substantially. And vaccination rates in Africa have fallen behind, and this is vaccination by GDP per capita. And the orange dots represent African countries, and the grey dots represent other countries not in Africa. So Africa is doing very poorly in terms of vaccination per capita, per GDP per capita. And one of the issues clearly is there's a social problem in these countries with COVID running through them, but there's also the issue of the more people who contract COVID, the more likely variants are to mutate, evolve through mutation, and the more likely we are to get different variants and more dangerous and difficult to deal with variants. So as a global population, we really want to manage the vaccination program aggressively and minimize the number of people who catch this virus. In Europe, travel to work for European workplaces growing rapidly and is now probably down about 8% from where it was pre-pandemic. Employment opportunities are higher than pre-pandemic levels, but of course there are a lot of jobs furloughed, lost, etc. during the pandemic. So we need to wait and see how that settles down once reopening has persisted for a few months. Use of public transport is increasing and almost back to pre-COVID levels, but air travel, which clearly is indicative of the amount of international travel, is substantially down and isn't showing any signs of increasing above that minus 50% level, where it's been stuck for the best part of a year. In the United States, the economic effects tracker that we like to show you sometimes, this is small businesses open, and the small businesses open is not going anywhere. It looks pretty sick. And one of the theories as to why the bond rates fell when after the Fed last week said that they were thinking about raising rates and reducing stimulus is that, or tightening, is that the market was looking through all of that and thinking that in the second half of this year, that the economic growth that we've seen recently will die down and start to reflect the damage that has been done to the economy. Now, we don't know, we shall have to wait and see, but this particular indicator is not looking good. So moving on to inflation, wage growth accelerates for low-earning Americans. We've covered that a few minutes ago with the Amazon floor, but there is a slight exponent look to that graph from 2011 to 2021. And warehouse workers' pay has been substantially boosted, 10% in the last 6 months. And again, that is reflected in Amazon's response. But it all suggests inflation may be a bit more sticky than the central banks and politicians would like to have us believe. And the Bank of England has consistently underestimated inflation this year. So the grey line at the top is the official data, and the Bank of England's forecasts for February and May both underestimated that official data. And as you know, there are cynics who think the official data itself underestimates inflation. So clearly the Bank of England is on the wrong side of what's happening to inflation in this country at the moment. This is an interesting graph just showing sort of long-term consequences for renewable energy, for net zero pathway. How do you get to net zero? So oil supply has to drop to the low 20s. This is over the next 30 years by 2050. Critical mineral demand in millions of tons, which is metals, copper, rare earths, battery metals and so forth, has to go up by about 6-fold. And the share of solar photovoltaic and wind generation goes from around about 8 or 9% up to 65 or 70%. Personally, I can't see how that works because of the unpredictable nature of solar voltaic and wind generation. And I suspect that it's going to have to be less than that in order to provide a consistent power demand, unless large-scale battery storage comes in. So onto the weekly checklist. FTSE all share virtually unchanged, S&P up 1%, Nasdaq up 1.5%, Topix up nearly 1%, Bitcoin down 10%, and GBP US dollar virtually unchanged. So Bitcoin, this is a monthly graph of Bitcoin, shows that it's basically undergone a 50% drop. And this is the logarithmic chart, as I showed the other week. And as you can see, if it were to touch the logarithmic line, it would probably touch it somewhere around about here, or over on the right-hand side, at maybe a price of between $15,000 and $20,000, which suggests that on that basis, it has quite a long way to fall, but it may not do so, or it may do so a long way further out. This is the Ethereum chart, and it looks rather like a head and shoulders chart to me. One shoulder, peak, second shoulder. Now, head and shoulders charts, when they resolve and do what they're projected to do, typically fall the height of the peak from the shoulder down, which would take Ethereum back down to not very much at all. And we shall see, but right now I am not, I don't own any Ethereum or Bitcoin, and I don't propose to buy any until this price shakeout has finished. And I'm not quite sure how we determine how it's finished, but my view is it hasn't finished yet. And it may have quite a long way further to go. This is a logarithmic chart for Ethereum, which you can see might sort of cross that line or hit that line at around about 500. Industrial commodities, aluminium unchanged, cobalt unchanged, copper up 2%, chromium up 1%, iron ore down 2%, lithium unchanged, neodymium down 3.5%. You will recall some time back he's commenting that neodymium is actually not in deficit. There's plenty of it around, and this may be a reflection of that fact. Nickel had an amazing week, up 6.5%. Ferrovanadium up 3.5%. WTI up 3.5%. Coal up 3.5%. And uranium still knocking around the low 30s, not moving very much. So a bit of a mixed bag for the commodities, some significantly up, some significantly down. The aluminium chart looks like it's consolidating. It certainly doesn't look as if it's going to drop rapidly from here. Cobalt, it didn't know where it's going to go from here, but it's had a big drop and it has bounced from that 42,000 point. Copper looks like it has done a consolidation and is probably going to go back up again. In my view, I think because there is this ongoing projected significant shortage and a huge projected demand in the face of that shortage from the electrification of the world. Iron ore is not very far off its peak. The infrastructure bill from the US will presumably, the $1 trillion infrastructure bill will presumably place more demands on copper and iron. So one is likely to see these prices strong for some period of time. Neodymium, as we said, it has basically plummeted and is continuing to drop pretty rapidly. Nickel is looking strong again, having had a big shakeout. Ferrovanadium can do no wrong. Up again this week, and a very strong looking chart there. Australian coking coal has risen by 50% in the last 2 months. WTI oil is still trending upwards and isn't really showing any weakness in that chart. And this is thermal coal, and it too is in a strong run up. On to precious metals. Gold and silver, very little changed on the week. Platinum up nearly 3%, rhodium a massive drop of 15%, and palladium up 4%. So the gold price has dropped very significantly from 1900s, appears to have steadied itself at around about 1780. We shall see where it goes from here. Silver price pulled back, but has stayed within that 24 to 28 range, being in the middle of it. So although it was quite a big pullback, it's not sort of threatening the current level where it's been for the last 7 or 8 months of between $28 and $24. Platinum a bounce, difficult to know where it might go from there. Rhodium not looking happy, looking a little bit like a neodymium chart, and certainly one to expect to drop further, I would think. Palladium has had a bounce. Yields and rates, so the US base rate unchanged, US Fed funds rate unchanged, UK 5-year down nearly 3%, UK 10-year down 1.45%, UK 20-year up 0.5%, and UK 30-year up 1.5%. So some fairly big interest rate moves going on there. I don't pretend to be an interest rate specialist, and I don't want to speculate as to why those changes may have occurred, other than presumably reflects the market's view of long-term outlook for both inflation and growth. So the UK 30-year gilt yield basically hasn't really moved for the last 3 months. And our final graph, the seasonality chart, the markets didn't really go anywhere. The seasonality chart suggests that actually the US market went up The seasonality chart suggests they should have done less well, so we seem to have deviated at this point from the seasonality chart. Keith will be bitterly disappointed by that, but hopefully next week we shall rejoin the predictive nature of this chart. And speaking of next week, we hope to be back with you, the two of us, for a full weekly update. But in the meantime, hope you've enjoyed this one, and if you have, please press like and subscribe to our channel. And it's goodbye from me, and I look forward to seeing you all again next week. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website, or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.